Well, thank you so much for the invitation. Really appreciate it. So this paper is titled Credit Market Equivalence and the Valuation of Private Firms, and it's joint work with Lukas, Schmid, and Roberto Steri, who are also in the audience in the back. And well, our setting here are leveraged buyouts. So as we all know, in a leveraged buyout, a company is taken private with substantial amount of borrowed capital, most notably from the leveraged loan market, with the objective of a later resale of the lengthy period of restructuring. We also know that leveraged buyouts have become increasingly popular for long-term investors, such as endowments and pension funds. So to kind of like give a number here, when we look at the commercial data provider Preqin, they basically reported that private equity assets under management are currently up of roughly 5 trillion and expected to double by the end of 2025. So plausibly, the growth of private equity has been fueled by favorable credit conditions in low interest rate environments. And this is kind of like also what's been talked about lately a lot in the news, and you kind of see this here in these two graphs. So on the left in blue, you see the number of LBOs, and on the right in blue, you see the volume of LBOs. And you can sort of like see that recently increased with a decline in the average loan spread to maturity, which is depicted here in orange. So this is a measure of the average credit spread in loan markets. So given the popularity of these investments among investors, the evaluation of performance of LBOs is an important question in asset management. The problem from an asset pricing perspective of private firms is that they are private. So we can't really observe a lot of real-time market valuations between the time they're bought and the time they're exited. We have cash flows, we have some valuations, but most of them are self-reported. So again, this is a problem from a performance measurement and benchmarking perspective, since we can't really learn from prices about these companies. Our starting point here is to look at, or basically that a lot of these companies actually have a lot of leverage. As I pointed out earlier, we focus here on leveraged buyout funds. And our idea is to make use of the simple observation that we surprisingly often have market valuations on the debt side of these companies. So when a large company is taken private by a private equity firm and it had corporate bonds traded once it was public, it will still have corporate bonds traded once it's private. And then for a lot of other of these companies, we actually have loan data, some transaction data on loans, but also quotes of dealers in the secondary market. So this gives us some sort of market signal about how the market evaluates some of the claims to these companies. So in this sense, we can ask the question, can we learn about the valuation of private equity from prices that we observe in debt markets? So we basically make this assumption all the time. We apply the Merton model. So Merton tells us that debt prices and equity prices are options written on the same asset. So especially in a practical formulation, Leland shows that debt prices depend on the distance of the asset value to the default boundary. So if you think about, if in other words, if the debt price is low, that means the asset value is closer to the default boundary. Asset values are low. Well, if asset values are low, that also means that debt prices are low, that the equity values are low. So in other words, what this insight tells us here from Leland is that debt prices can be informative about equity values. And well, what are we looking at? We are looking at leveraged buyout funds or leveraged buyouts. So we are looking at companies that have leverage ratios of, let's say, 70 to 80%. So obviously here credit risk matters. So given Leland's insight, we're now going to take that and we're going to use standard tools of modern empirical asset pricing to learn about the valuation of equity from debt market prices. So what we do is we estimate an empirical linear factor model from debt market data. So if you think about the Euler equation, 1 equals EMR, we try to come up with an M, a stochastic discount factor for equity from debt. Well, and we observe cash flows, so we can basically do valuations. And that's by using the discount factor, and that's what we call the credit market equivalent valuation to private firms, or something that we label the CME, and you'll soon see why we're going to call this the CME. So to briefly give you a snapshot of the data that we are using data from two private equity sources. One is a proprietary data set from a large institutional investor where we have deal level information as well as fund level information. So we actually observe the underlying holdings of these funds. And then we have data from Preqin where we have fund level information, where we see the cash flows coming in and out of funds. So given that we have a proprietary data set where we see the underlying holdings, we can match those deals to loans that are traded in the secondary market from the database LPC. And after merging that data, we actually find that 80% of our sample funds have traded loans in the secondary market. Ultimately, we complement that data with various other databases such as Trace, Orbis, Capital IQ. We look at a pitch book and several others. So it turns out that we were not the first to figure out that, or to notice that coming up with an SDF to evaluate private equity is not an easy undergoing. There's been others before us that looked at this problem. So we have Kaplan and Chouar, who came up with something they call the public market equivalent, or the PME, which is based on an SDF of an investor who is entirely invested in the stock market. And then after relaxing a little bit the stringent assumptions here, Kordewick and Nagel proposed the generalized public market equivalent, or the GPME, which is based on an SDF of an investor who is entirely invested in the stock market and a risk-free asset. And then after relaxing a little bit, which is kind of like in line with an SDF proposed by Gupta and Van Nierenburg, who also add additional risk factors to that. Ultimately, the general wisdom that we have from these measures that are used in the literature is that buyout funds outperform on average. So, and so far we can certainly say that these measures are widely used, and it's definitely a good strategy. Nevertheless, we propose to do something slightly different. We propose a leverage based down. So we propose to extract information on prices of credit instruments to come up with such a stochastic discount factor, such an SDF. So, and to do that, as I said, we have data on loans from LPC, which we match to roughly 500 companies that are held by roughly 100 private equity funds. As said, 80% of our sample. And what we ultimately do is we use that data to replace stock returns on the stock market portfolio that you will find in the SDF of Kaplan and Chouar and Kordewick and Nagel, with a return of a number J of credit market instruments. So ultimately, I'm going to show you in a couple of slides that this number is going to be 5. So J actually is going to be 5 in our setting. And well, how does that SDF look like? Well, it takes this form here, and what it helps to answer is the question: are private firms' equity consistently priced with their debt, or would investing in private equity improve the risk-return relation of an investor already invested in these private firms, but through their debt side? And of course, this approach makes sense if debt and equity markets are not entirely segmented, and if the SDF is basically a relevance performance benchmark if private equity investors also have credit exposure. So now the natural question would be, who invests in credit? So what's the credit exposure of a critical LBO investor? Well, luckily for our proprietary data set, which is basically an investor that runs a large fund of fund, we also observe their overall allocation. So besides them investing primarily in buyout, they also invest heavily in venture capital, as you can see by these pie charts, and also in private debt funds. So on the left, you see their investments sorted by split up by the number of investments. On the right, you see their investments split up by the size of investments. You can see that even when we do the split by the size, we see even a larger allocation to private debt funds. So I also want to mention that for all these Preqin funds that we have, we are able to match that data to a pitch book where we see the allocation of the investors in these buyout funds that we're looking at. And we actually find that these investors that invest in our Preqin funds are also invested in public equities, in debt instrument, as well as in private equity. To give a more like general view of the market, we look at a recent report by the IMF where we know that roughly we are looking at $4 trillion invested in the overall or in the global leveraged loan market. So important here is the takeaway that investors that invest in private equity are also all investors that directly invest in the leveraged loan market, such as financial institutions, pension funds, insurance companies, but also indirectly through CLOs, and as you can see on the right, through private debt funds. So as you see here, these are public pensions, foundations, endowments, insurers, all invested heavily in private debt funds. So the takeaway here would be that benchmarking against credit factors makes sense since the underlying portfolios are achievable by a private equity investor. Well, sort of like after having established that fact, there might also be comparative advantage of using private debt as opposed to public equity here. So why is that? What are the differences between public and private equity? Oh, sorry, private debt here. It would be liquidity. Under diversification, we have differences in clientele. We have differences in how informed investors are. And we have differences how active and passive investors are in private markets compared to public markets. Okay, so these might all be factors why we might not want to benchmark private equity performance against that of public equity. Well, to use information or to use information, this information to come up with the valuation of private equity by extracting information from debt markets, we first of all need to understand what drives debt prices. So we do the same exercise that we do with stock returns. We sort returns into portfolio based on some characteristics, and then we like to see that these characteristics reflect some cross-sectional variation with respect, or that there is some cross-sectional variation basically with respect to these characteristics in loan markets. So we do quintile portfolios. Well, and if there is cross-sectional variation in loan returns, we'd like to think that this cross-sectional variation reflects some differential exposures to risk factors and their pricing. So the question is, what factors, if any, can explain these return differentials? So we basically enter the factor zoo here. And then we use high minus low quintile portfolios, sorted on characteristics here as candidate factors, and follow with our standard two-stage regression approach where we run time series regressions of portfolio returns on factors to get our exposures. And then we check whether the average portfolio returns line up with these exposures in the cross-sectional regression to get our risk prices. So, and this is where our little machine learning exercise Lasso comes into play that helps us to identify the relevant factors. So what do we find? We find that 5 factors price the cross-section of loan returns well. What are these factors? It's momentum, positive risk price, it's volatility, positive risk price, it's price. This is the high minus low price portfolio, which is the current price minus the par value. So you can think of this as the market to book portfolio, which is the opposite to book to market. The book to market comes in with a positive risk price. Market to book comes in with a negative risk price. MV, market capitalization, is priced negatively. And the bid-ask spread, so we have the bid-ask spread, so liquidity is priced positively. So ultimately, the takeaway here is that results from the second stage regression suggest the 5-factor model for debt returns, which is based on portfolios of characteristics that are somewhat similar to what we see in stock markets. So ultimately, what we do is we line up our average cross-sectional returns with our predicted average returns, and we are hoping for a 45-degree line I would say somewhat 45 degrees, and the cross-sectional alpha is small. So the takeaway would be that the 5-factor model seems to do a good job in pricing our quintile portfolios. So what about the M? I started talking about the M. So the M is exactly what I argued earlier. It depends on these factors with a significant risk price. And we use that as the M to price our private equity cash flow, given that I was making that argument that private and debt markets, private equity and debt markets are not entirely segmented, and that those private equity investors have exposures in credit. So what are our results? So these are our results. We do valuations based on our data set in Preqin and our proprietary data set. And what we find is we do valuations using the standard measures that are proposed by the literature, which are the GPME and the PME. We find that the GPME and the PME comes in with high overperformance. So buyout funds overperform if you use SDFs based on an investor that is entirely invested in the stock market and a risk-free asset. Now we look at what happens with the valuation by using our valuation approach, the CME, and we actually find a slight negative performance based on the Preqin data and pretty much a price of 0 based on our data. So the takeaway would be that the CME seems to absorb the GPME and the PME's overperformance in buyout. So now why is that? We kind of do a couple sample splits to get a better idea of what's going on here. So we split down the sample in the middle for funds below median leverage and funds above median leverage. And we see, based on our CME, that funds below median average have a slight overperformance, whereas funds above median average have a slight underperformance. So this kind of like suggests that buyout managers do not appear to successfully arbitrage debt market against equity markets when debt is cheap. And this is kind of like the takeaway also when we split the sample based on boom and bust periods. We can see that based here on the CME, we have a strong negative performance, both in our sample and in Preqin in the pre-financial times, 2004 to 2007, which are labeled the heydays of buyout. And again, the idea is these guys lever up when interest rates are in good credit conditions. Most of the stuff is loans are floating rate instruments. Interest rates increase. In a recession, obviously, it's also going to be more difficult to repay due to lack of resources. And we actually pick up that effect by showing negative or underperformance based on the CME. So we also add additional factors to our SDF. We include the public market as an additional factor, and we estimate something that we label the CEME, the credit equity market equivalent. We still see we see slight overperformance here. Nevertheless, much lesser than what we would see based on the GPME. So, which is kind of expected. I mean, we add the market, but we didn't, and obviously control for our credit factors. So we don't find overperformance as high as we would find based on the GPME measure. So last but not least, since I'm getting close to running out of time, we also test our approach on a sample of public companies where we actually observe returns. Okay, so we look at a sample of companies that have similar characteristics to our private companies and that have traded loans in the secondary market as well. So we run the state-of-the-art 5-factor model along the lines of Farmer French and Huxiong Tseng, and ultimately add our credit, our loan factors to that model. And what we see is that the adjusted R-squared jumps from 0.6 to 0.7 after including our credit factors. So this kind of suggests that it might be a good idea to include credit factors or control for credit risk also in public companies that have somewhat similar characteristics what we see in private markets, meaning that have high leverage and also loans trade in the secondary market. And also this also gives us some sort of like external validity here. I'm out of time, so let me conclude. We asked 2 questions. The first question is, can we learn about the valuation of private equity from prices in debt markets? And the answer was, or our answer is yes. private equity and leveraged loan investors actually may have more in common than private equity and public equity investors. The second question was, can we use the credit market equivalent valuation to value private firms? And the answer here again would be yes, because accounting for credit market exposure actually helps understanding private equity valuations. I think I'm out of time, so that's it.